Getting a mortgage is a big step, and in today's economic climate that step can seem even bigger. But it doesn't have to be. By doing your research and getting the facts, you'll be in a better position to choose a mortgage that's right for you, whether you're moving for the first time or for the 10th. Before I talk about the detail of getting a mortgage, I thought I'd take a moment to explain exactly what a mortgage is and the different types of loans. When you borrow money to buy a home, this is known as capital. You'll also be charged interest on that money. The capital you've borrowed and the interest on top will need to be paid back over the course of the mortgage. Unlike other types of loans, a mortgage is secured against your home, so if you don't keep up with monthly repayments, the bank or company that lent you the money could apply to a court to repossess your home and sell it to recover the money lent. With all that in mind, let's get to grips with other key aspects of getting a mortgage. The first thing to consider is your deposit. The deposit is the amount of your own money that you put towards buying your home. If you're not ready to buy just yet, you're usually better off waiting and saving some more while you do. That's because a larger deposit will usually mean it's more likely a lender will agree to your mortgage. Even if you currently own a home, adding a further contribution to the money when you sell could really help. You'll borrow less and could pay less interest overall, and this improves your loan-to-value ratio when buying a house. You'll also find a wider range of mortgages to choose from, and having more choice is always a good idea. Now, when it comes to paying back your mortgage, you've basically got two options: a repayment mortgage and an interest-only mortgage. With a repayment mortgage, the payments you make pay off the interest due each month and a little of the debt. So when your mortgage ends, you'll have paid off everything you owe. This way of paying off your mortgage is thought to be the easiest to understand and the least risky. With interest-only mortgages, your monthly payments will tend to be lower, but you need to realise that you're only paying the interest on the amount you've borrowed, so you're not actually reducing the loan itself. This means at the end of the mortgage term, you still owe the full amount of the loan. If you do go with an interest-only mortgage, you need to have a plan to pay off the loan, such as investments or savings, because if you can't pay the mortgage in full, at the end of the term, you could risk losing your home. Now, we all know that borrowing money isn't free, so when you borrow to buy a home, your lender will apply interest in the mortgage loan. Of course, the lower the interest rate, the less money you'll need to pay back over the mortgage term. When you're looking at interest rates, you'll usually see lots of different terms mentioned, like initial rate, standard variable rate, or APR. For now, I'm just going to touch on the basics. Okay, so what's an initial rate? Basically, it's the interest rate used at the start of your mortgage deal. It'll last for the duration of the deal you sign up to. So, for example, if you choose a 2-year fixed rate, the monthly interest will be set for 2 years. Once those 2 years are up, you move on to a standard variable rate or follow-on mortgage rate. This is set by your lender and will last for the remainder of your mortgage. This could be more than 20 years unless you choose to switch to another deal. Finally, there's APR, or annual percentage rate. This rate is worked out using a set formula and includes any charges such as administration fees. And while this is an annual figure, it's calculated to take into account the intended life of your mortgage. You should use APR to compare true costs of different mortgages. If you find two mortgages with different APRs, then you know the one with the lower APR has a better rate over the lifetime of your mortgage. So you need to make sure you do your research. Now that you've got to grips with interest rates, it's time to choose a mortgage. Lenders offer different types of mortgage, with the three most common being fixed rates, trackers, and offset mortgages. Let's look at fixed rate mortgages first. This option does exactly what it says on the tin. Your monthly interest rate is fixed for a period of time, such as 2, 3, or 5 years, even if interest rates go up or down. So it makes it easier to budget for. A tracker rate mortgage is the opposite of a fixed rate product, as it tracks at a rate outside the lender's control, usually the Bank of England bank rate. Every time that rate goes up or down, so does the interest rate on your mortgage. These days, with interest rates so low, this type of mortgage can seem appealing, but you need to make sure that your budget will stretch to higher monthly costs if the interest rate goes back up. Also, bear in mind things like early repayment charges. These are charges you may have to pay your lender if you break off your mortgage deal by paying it off early or moving to a different lender. The third main type is an offset mortgage. This is worth thinking about if you have a large sum of money in your current or savings account that you could use to offset the amount you pay towards your mortgage. Depending on your circumstances, offset mortgages can be a good way to reduce the interest you pay on the term of your loan. Some mortgages also offer additional services such as making overpayments, a free valuation, or free legal fees. Be sure to check each mortgage offer carefully before deciding which is best for you. When you apply for a mortgage, a lender will review your application based on your income, outgoings, as well as your credit history. They'll arrive at a figure they are prepared to lend you and that you can afford. If you're a first-time buyer, it always helps if you can show you've been paying regular rent for a similar amount that you're hoping your mortgage payments will be. You could also get a copy of your credit report to make sure your credit history is in good financial shape. I hope this overview has given you a good sense of what's involved in taking on a mortgage. Obviously, it's a complicated topic and you should do as much research and shopping around as you can. But to sum things up, here are the key things to consider when you're looking for a mortgage. How much deposit do you have? What type of mortgage do you want? How do you want to repay it? And lastly, know your interest rate terms. Doing your research and arming yourself with information will really pay off because you can sit back, enjoy your new home, knowing you've got the right mortgage deal for you.